Imagine striking gold, a sudden windfall that turns your modest investment into a fortune. In November 2023, Tata Technologies made headlines when its stock got listed. The shares were offered at rupees 500, but they closed at a staggering rupees 1314 on the first day. That's more than a 160% gain. Consider the case of Paytm. By the end of the lock-in period, the share price had plummeted to rupees 535, an 85% drop from the unlisted market price. Companies like Waaree Energy and Axles India have seen their unlisted shares soar by over 200% in a year. Welcome back, friends. Today we have an exhilarating topic that promises to keep you on the edge of your seat. We are talking about unlisted shares, a world that's often described as a gold mine or a minefield. But which one is it really? Stick around to find out as we unravel the mysteries of unlisted shares, inspired by an insightful article from The Economic Times Wealth by Babar Zaidi. Imagine striking gold, a sudden windfall that turns your modest investment into a fortune. Sounds exciting, right? But what if instead your investment plummets, leaving you in a financial pit? Unlisted shares offer both these thrilling highs and devastating lows. Let's explore this uncharted territory together. Let's start with a story that captured the attention of investors everywhere. In November 2023, Tata Technologies made headlines when its stock got listed. The shares were offered at rupees 500, but they closed at a staggering rupees 1314 on the first day. That's more than a 160% gain. Investors were ecstatic, but not everyone walked away a winner. A few weeks before the IPO, Tata Technologies shares were trading at around rupees 860 in the unlisted market. Investors who bought at this price saw their investment rise by only 53% on the listing day. But hold on, it gets more intriguing. Due to a lock-in period, pre-IPO investors couldn't sell their shares until 6 months after the listing. By then, the share price had dropped to rupees 1,030, trimming their gains to less than 20%. This brings us to a crucial point. The world of unlisted shares is volatile and unpredictable. It can offer enormous returns, but also carries significant risks. Let's dig deeper, as Babar Zaidi explains in his detailed analysis. Now here's where things get really interesting. The Primex 40 Index, which tracks the performance of 40 top unlisted companies, hit an all-time high recently. This index has outperformed the benchmark Nifty 50 over the past 3 years. Sounds promising, right? But wait, the returns are nowhere near those of the Nifty Midcap 100 and the Nifty Small Cap 250 indices. Look at these numbers. While Primex 40 showed an 18.2% annual return, Nifty Midcap 100 delivered 27%, and Nifty Small Cap 250 was close behind at 26.2%. This disparity raises a big question. Are unlisted shares worth the risk? Let's talk about volatility. After the initial surge post-COVID, the Primex 40 index shot up by 70% in just 6 months. However, it fell in 2022 and stayed flat for nearly 18 months before recovering in early 2024. In contrast, Nifty indices have shown much more stability and lower volatility. Consider the case of Paytm. In September 2021, its unlisted shares traded at around rupees 3,200. But when the Paytm IPO was announced, the price band was lower, and the stock plunged 27% on listing day. By the end of the lock-in period, the share price had plummeted to rupees 535, an 85% drop from the unlisted market price. Such dramatic falls can leave investors in dismay, watching their investments evaporate. But there's more. The lack of transparency and liquidity in the unlisted market makes it even riskier, as highlighted by Babar Zaidi in The Economic Times Wealth. However, the story of unlisted shares is not all doom and gloom. There are success stories too. Companies like Waaree Energy and Axles India have seen their unlisted shares soar by over 200% in a year. But for every success, there are tales of caution. Remember Byju's? Once valued at $22 billion, it faced a massive devaluation, dropping to just $1 billion. Or take the case of ThyroCare's founder, who reinvested in Farm Easy, only to see the value of his investment plummet by 92%. Then there's the issue of liquidity. Close to half of the 600-odd unlisted shares aren't traded regularly. Some don't see any buyers or sellers for months. Imagine being stuck with shares you can't sell. And let's not forget the costs. From brokerage fees to transaction charges, investing in unlisted shares can be expensive. Plus, they come with tax disadvantages. Unlike listed stocks, which enjoy favorable tax treatment, unlisted shares are taxed at higher rates and don't qualify for certain exemptions. So, should you invest in unlisted shares? It's a tough call. While they offer the allure of high returns, they come with substantial risks. The lack of transparency, liquidity issues, high costs, and unfavorable tax implications make them a tricky investment. If you're considering diving into this volatile market, make sure you do your homework. Research thoroughly, understand the risks, and be prepared for a roller coaster ride. Unlisted shares can indeed be a gold mine for some, but for many they might just be a treacherous minefield. A big thank you to Babar, Zaidi, and the Economic Times Wealth Edition for providing such a detailed and insightful analysis on this topic. Thank you for joining us today. Stay tuned for more insightful and exciting content. If you liked the video, smash the like button and share with friends and family. And remember, in the world of investing, knowledge and caution are your best allies.